Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and it's December the 1st, 2016. I don't have to tell you that November turned out to be a raucous month when it came to the capital markets. And so I want to talk a little bit about what happened post the US election. You might remember in my last update, I talked about the US election and Donald Trump's victory and why the capital markets actually should be happy about that victory vis-a-vis Hillary Clinton. And indeed, the markets overall have gone up. But what we've actually seen is a lot of changes in terms of the different asset classes and where money has gone and also where money has come out of. And so some of the market averages have worked their way up, but underneath the surface, there's been dramatic shifts in terms of some of the different sectors. And I want to talk a little bit about that. So what's going on? Well, according to the experts, once Donald Trump was elected, we have embarked on what they're calling a reflation trade, that we're going to get inflation back into the U.S. economy, and that's going to spill over to the global economy. In fact, some of the economists have raised economic growth estimates for the whole globe based upon what they think is going to transpire in the United States. And so let's talk a little bit about that. So what is the reflation trade? Well, there's basically sort of two components to that, I would suggest. Number one, increased fiscal spending. So the assumption that the markets are operating on now is that there's going to be this, what we've talked about before, helicopter money. There's going to be a lot of spending at the government level. They're going to pump a lot more money in because they're going to spend money. And in particular, that money's going to be spent in the area of infrastructure. And so fiscal spending leading to reflation in terms of the economy, speeding the economy up, getting more money into the system, not just through the central banks and through the monetary apparatus, which is what we've seen in the last sort of 8 years, but now much more government spending. Okay, so that's what they call sort of that reflation trade. Now, part also of the reflation trade, the second component, not just fiscal spending, will be fiscal stimulus. What does that mean? It means the tax side of things. And Donald Trump is talking about cutting taxes substantially. And when you cut taxes, that means people have more money. Corporations are going to have more money because he's talking about substantial corporate taxes. And again, that money gets pumped into the system. So people are looking at this and they're saying, whoa, we're going to really speed up the amount of money coming into the economy, and it's going to lead to inflation. And if it's going to start leading to inflation, then that's going to have some dramatic impacts in terms of the capital markets. And that's what I want to shift to right now. So a reflation trade, more fiscal spending, more fiscal stimulus, and that's going to lead to, I think, two major implications. And we've already seen this throughout the month of November, and it's had a dramatic impact in terms of valuation. So first, large increase in interest rates. We're coming off of historically low rates. In fact, we've talked about this before. We've never seen the kind of low rates that we witnessed over the last year. And you can go back 5,000 years. I mean, you can go back to 3,000 years before Christ, and you're not going to get interest rates in recorded history as low as we saw them, including negative interest rates. So now with reflation and the idea that there could be some inflation, you're seeing interest rates come up dramatically. And so throughout the month of November, we saw a large uptick in interest rates. Now, what does that mean, and how does that impact the market? Well, it means that bond prices are starting to get smacked down, because as interest rates come up, the value of bonds come down. And so anybody with bonds that are 3 years or more in terms of duration, especially long-term bonds, have just got smashed hard, and valuations are down, in some cases 10% and more if you have long-term bonds. And they estimate that around the world there would have been close to $2 trillion of losses in bonds just in the 3 weeks after the Trump election. So bond prices come down, interest rates go up. All lending rates are starting to go up. So this is going to impact mortgages, car loans. Every time you borrow money, the costs now are starting to go up. In fact, we've seen a couple of increases in mortgage rates here in Canada already by some of the banks. This means also that stocks that trade off of high dividends will come down a little bit. And we also saw this in November. So real estate trusts, some of the infrastructure companies that trade on high yields, some of these businesses, because they've been trading off the yield and interest rates are going up, then they will come down a little bit. The value of those businesses will come down a little bit, and they'll settle out over time. And I'll talk a little bit about how we approach that. And also, as interest rates come up, it'll put a little bit of pressure on precious metals. So gold and silver will be weak, and we've certainly seen that in the month of November, because as interest rates come up, people say, hey, I can make a return on something else, so why would I buy gold or silver, which are largely just monetary substitutes or operate sort of as currency. So that's sort of the impact, number one, in terms of this reflation trade. You're getting an increase in interest rates. How do you deal with that? Buy businesses that are growing, their dividends are expanding. That'll protect us against the increasing interest rates. Have no medium to long-term bonds. We don't have any long-term bonds in our book of business. None of our clients are exposed to these big bond losses, which is good. Be patient with precious metals, because if interest rates are going up and there's a reflation trade, precious metals will do just fine in an inflationary environment. That's what they're good for. And so that's the first aspect that I just wanted to talk about. The second area with this reflation trade and this enthusiasm with what Donald Trump is reportedly going to be doing means that the US dollar has gone way up since his election. And so if the US dollar is going up, of course, that has implications to all sorts of investments. Multinational companies that make money around the world, when you value them in US dollars, the value of those businesses are going to drop, because a lot of money they make in the emerging market countries, those currencies have dropped a lot. And so multinational corporations and their profits are under pressure, number one. Number two, precious metals, again, will be under a certain amount of pressure because they're valued in US dollars. And as long as the US dollar is going up, it's hard for the precious metals to make advances. The emerging market countries are getting hammered because their currencies are dropping very quickly, and so they're getting an inflation coming into their countries because of the fact their currency have dropped and they have to buy things in US dollars. So how do you minimize the effect of a rapidly increasing US dollar? Be careful about buying in countries outside of North America. We're kind of hedged and linked to the US dollar even when our dollar drops, so it's not as big a deal being next door in Canada, although there are obviously some implications. Be patient with precious metals. They will really rebound when this thing turns and when we reach the end of this sort of reflation trade and this reflation sort of repricing of assets. And then look to companies that have been smacked down, are cheap, because of what's happened in the last 3 weeks, and start to dollar cost average and buy. So companies that have large international exposure, one of the companies we have in many of our clients' portfolio is Nestle. And Nestle makes a lot of money around the world in a lot of emerging market countries, and that stock is down 15% or more just in the last few weeks. Well, that too will return to more equilibrium over time, provides an opportunity to buy something that's more cheaper in terms of its price relative to the long-term prospects. So that's this reflation trade. Interest rates are coming up. The US dollar's been strong. But this too will pass. And so I just want to emphasize a couple of things about the big picture. The big picture around the world has not changed. There is way too much debt. In fact, what Donald Trump is talking about will increase deficits and probably increase U.S. debt as he sort of supercharges the economy. The accumulated debts are rising around the world. Funding costs are now actually going up. So interest costs are going up, which will make it more difficult on all of the debt that's out there. So just hold on, wait. We're going to see this work itself out. And so it's not just going to be straight up from here. We want to keep balanced and be very careful, very prudent in terms of how we're investing. And all these unfunded liabilities around the world, given the aging populations in Japan and Europe, which is under severe pressure with what Donald Trump's doing in the States, is really putting a lot of pressure on Europe. These things, again, haven't gone away and are still major challenges. So what are we doing in the middle of all of this? Look, it's a tug of war, and we have to stay very much focused on what's the medium to longer term objectives are here. Keep some powder dry. We're keeping some cash, being very careful, take advantage of volatility. We don't have anything in long-term bonds or medium-term bonds. Interest rates could continue to back up off of historic lows. This is going to be an area of major pressure and certainly not very good returns, if not even negative returns. So we'll be very careful there. We want to be in short-term bonds. As they come due, we can reinvest those at higher yields if yields continue to go up. 3, buy companies that can grow their dividends. And so they're expanding businesses. And so even though some of the companies we have that pay good dividends have come down a little bit through the course of November, as they grow their business and expand their business, the dividends will more than compensate in terms of the dividends growth for the pressure that's been put on them by increasing interest rates and the competitiveness for the interest income versus dividend income that you get from the stocks. Also, buy quality businesses, essential businesses, productive companies. Don't lose focus, and we're not going to go running after a lot of these speculative sort of trends that have emerged in the markets. We'll take advantage of the areas that have been pummeled and hit hard and go and buy good companies there. And in areas where we've done very well, we'll be very careful and not be adding to some of those positions in some of the energy space, which has jumped up, and some of the other businesses in financial services. Some of the banks have done very well. So we'll be very careful about adding there and try to add where there's really good value. So it's been a raucous month, might continue, but again, one person, one government isn't going to change all of the dynamics of the global environment. And they'll have an impact, no question about it, and I think a positive impact, but we are well positioned to be able to deal with those issues the way we position ourselves in terms of our portfolios. So thank you very much. Trust that is helpful, and we'll probably try to send out another update or two before the Christmas holidays. Thank you very much. Bye now.